Julia, what did you make of this session? It was a choppy Wall Street session, but we got a decent lead. Not big gains on our market, though.
All this week, it just feels like the market is treading water, and we have seen consolidation. In fact, we're back to where we were at the beginning of the week. And I guess the market just on hold till that EU summit on the weekend on the 23rd of October and ahead of the G20 meeting on the 2nd and the 3rd of November. Of course, we saw a great lead from the US markets overnight, and that was on the back of the Guardian article talking about the European Financial Stability Facility being boosted up to 2 trillion euros. That rumour was quashed, and unfortunately that's been bad news for the US futures, down by 0.6%, so putting a little bit of a dampener on the Australian market performance. If we have a look across the sectors, we started off with every single sector in the black this morning, but coming to the end of the session, and the one key drag on our market has been the materials space. Yesterday we saw stocks like Fortescue losing 9.2% because of that huge tumble that we've seen in iron ore prices. Today Fortescue down another 2.6%. Yesterday Rio Tinto lost 5.5%. Today it was down another 1.8%. So a little disappointing there, but elsewhere around the market it did look quite strong. If we have a look at the healthcare space, the consumer discretionary, if we have a look at the property area, the financial area, information technology, all these areas saw gains of more than 1%. So take out the material space and the performance across the rest of the market was a pretty good one, but once again volumes anemic, only $4.5 billion worth of stock being traded. In fact, all this week we haven't been able to get above that $5 billion mark.
A chart perspective, I mean, we were sort of hovering around the upper end of that trend line. Is that still the case?
We are still at the upper end, but I guess there is a feeling in the market that perhaps we reached the top, the short-term interim top on Monday. And although we've seen low volumes this week, it's been anything but calm. Yesterday we saw some huge drops across the market down by 2.1%. Good to see a relatively calmer session today on the market, but I think investors there's still a lot of nervousness around Europe. It's not surprising that we do see defensive and high-yielding stocks very much in favour, and that's because over the last 3 months we've seen a huge tumble in markets. And when we do see markets falling, well, high-yielding stocks do tend to have a buffer against the capital losses in the market because dividends usually get paid whether or not stock prices are going up or down. So those high-yielding stocks have been very much winners. If we have a look at the banks, I guess we're having a look at a situation now where those traditional areas of growth, mortgage growth slowing down, we're seeing a very low credit growth environment. So I think what we're going to see over the next 12 to 18 months is probably a bigger emphasis on cutting down on costs. We've also seen legislation passed yesterday on covered bonds, so we're probably going to see more covered bonds being issued by the big four banks and banks in Australia. And if we have a look at the covered bonds, this is just over high quality assets on the balance sheet for banks. I guess it's unsure whether it's going to reduce the funding costs of the banks. Usually if we have a look at the market, they're probably going to have to offer 150 to 170 basis points above the bank bill swap rate. But this is a massive market globally. I think in 2010, this was a 2.2 trillion euro market covered bonds. And if we have a look, 300 institutions around the world, over 30 countries, but really dominated by the Eurozone. In fact, 90% of the market in that Eurozone area. So it does look like another option for those banks that have been falling quite strongly. The banks offering quite good yields, yields of between 7 to 8%, but unfortunately that hasn't stopped their stock price falling over the last 52 weeks.
Do you like them, Julia, at the moment? It's been talking, as Peter was and you were as well, about, you know, these high dividend yielding stock, a place of safety and so forth. I mean, would you be putting your money in the banks at the moment? And if so, do you have any preferences?
I think investors, when they are looking at high-yielding stocks, also need to consider the potential for capital gains or losses as well. Yes, the banks are yielding 7 to 8%, but when you consider that the share prices have fallen 20% over the last 52 weeks, that means that those dividend yields are going to have to work harder for longer to be able to make up that capital loss. So if we have a look at the banking story, yes, they are providing very strong yields, attractive franking credits, but the key question for investors is, doesn't matter whether those returns come from dividends or whether it comes from capital growth. So the growth picture for the banks, a much more difficult story. We are seeing very low credit growth conditions here in Australia. Australia. So I think what we will see is an environment where we are going to see the banks trying to aggressively cut costs to maintain those profit growth numbers that we've seen over the last decade. And it's been a fantastic run for the banks over the last decade. In fact, from about 1999 to 2007, I think we were seeing double-digit mortgage growth rates. Now they're down in the single digits, so a much more difficult environment for the banks. But if you do consider the dividend yield, if you do consider the valuations, yes, they look extremely attractive. But if you consider the growth opportunities, well, they're not looking so attractive.
Mark